Kristina Hooper joins us here in Studio 2, Chief Global Market Strategist over at Invesco. An eye on today and, of course, an eye on 2025. We've been talking a lot about that, Kristina, and I am curious about kind of the biggest risk that investors should kind of keep their eye on as we head into, or I should say, out of a record year in 2024. I mean, I don't want to jinx it. I know we still got a month to go, but most people think this is going to be a record year and we're going to possibly have a record 2025. What's the risk, though?
So I think there are actually a few key risks. One, of course, is the resurgence of inflation. And that can certainly be fanned by pro-growth policies. That can also be fanned by a very, very restrictive immigration policy that shrinks the labor pool. It can also be fanned by, for example, tariffs if they're applied for a significant period of time, and especially if they're quite large. The other risk I would point to is the potential for a Liz Truss moment. The idea that we are finally hitting that breaking point where bond vigilantism comes and drives up yields because there are not as many willing Treasury buyers out there. And I think that is a real risk. 2024 was our first year in which the line item in government spending for servicing our debt was larger than our entire defense budget. That's not sustainable over the longer term. And I think we're seeing greater fears. We've seen the 10-year yield go up because of a variety of factors, but I would say one of them is because of concerns about a lack of fiscal prudence.
Yeah, and it seems like most of the mainstream economists, when they're kind of assessing some of the policy proposals, if they were to be implemented, those debt levels and those deficit levels are certainly going to rise. The question is there not the potential for some equilibrium that even as the government's balance sheet maybe weakens a little bit, if there is a net positive effect on the economy and ostensibly the stock market, should investors be comfortable with that?
I think they should. I think this argues for diversification. I think all the uncertainty we see looking out is certainly significant, but there are also very significant opportunities. And so the best approach, in my opinion, the most prudent, is to be well diversified, both across and within the three major asset classes. That way we can protect against or hedge against some of the biggest risks and also take advantage of a variety of different opportunities presented by this environment.
The Liz Truss moment was interesting because I keep reading more and more about how the cost of leverage is now increasing as swap spreads fall because the back end of the curve keeps kind of rising and staying sticky, and that the funding, like the pipes, aren't going to work as well. When you take a look at it in terms of the catalyst then, what do you think is going to be that moment, and how do you sort of trade that?
Well, it's hard to see how that moment comes. I think what we're seeing now is, hey, here are some yellow flags. These are things that investors are worried about. But it could very well go in a different direction. Certainly if we see more discipline when it comes to fiscal spending in 2025, I think there's certainly a concern that a red sweep means that there won't be those controls. But if, for example, tax cuts are fully funded or almost entirely funded, I think that certainly takes down yields. I think that takes down the anxiety around this. I think we're a long ways away from a Liz Truss moment. This is an environment in which we have significant GDP growth. There's a lot going for this economy. There's a lot going for the government. I think investors just want to see signs that the government is going to be careful and do a little more to control spending.
So how does that affect the broadening out of the rally call that many have?
So I don't think it has a dramatic impact because I think in general what we're seeing is that financial conditions are easing, and that's supportive along with improvements in real wages. And that's a big part of our outlook for 2025 that's driving a reacceleration in the economy is that consumption improves because we see real incomes improving, real wages improving. And so from my perspective, I think we are going to see that rotation into cyclicals, into small caps. They are more sensitive to the economic cycle. And I think what we're going to see is a pretty strong reacceleration in the U.S. We're also going to see reaccelerations in the U.K., in the Eurozone, in Canada, the major developed economies. I think we also have the potential for a nice reacceleration in Japan, just given that those wage growth, what we've seen in wage growth is sustainable and could improve from here.
I'm curious, what's your advice to investors out there, to potential clients who look at the run-up that we've seen in the U.S. market? They're concerned about valuations. They're concerned about chasing a rally. And they say, is there anything outside the U.S. borders? Or is this primarily going to be 2025 a U.S. market story?
Well, I think there is legitimate concern. Valuations are stretched in the U.S., but if we dive down, valuations are not very high when it comes to small caps and when it comes to cyclicals. So, a rotation of some degree within one's U.S. allocation makes sense. And then abroad, there is a lot of opportunity. UK equities, very low PE ratios, high dividend yields. I think there's the potential for a nice reacceleration. Rate cuts should help there. Fed easing should be very supportive of emerging market equities and debt. So I think there's a lot of opportunity in areas where valuations are lower. I think as we enter the end of the year, this is a time to be rebalancing, taking profits, reallocating, redistributing. That doesn't mean walking away from tech and the mega caps, but it just means being better distributed.
What's that going to look like, though, for you? I feel like this year is going to be much crazier given the outsized gains that we've seen and how concentrated some of those gains are going to be. A lot of people are really going to have to rejigger their portfolios in a certain way.
Even modest rejiggering is going to help in terms of increasing exposure to small caps, taking some profits off the table. I think tech has long legs, but we're unlikely, in my opinion, to see tech outperform small caps and cyclicals in the near term. So just a small level of profit taking and rebalancing can make a significant impact on portfolios.
Kristina, always a great conversation. Always great to have you here in studio. Kristina Hooper, she's the Chief Global Market Strategist over at Invesco.